Hi guys, Josh here. I hope you're well. And today we've got a very special guest. There's nothing this guy doesn't know about Capital Allowances. He's one of the most respected names in the industry. Please introduce yourself.
Yeah, hi. It's Arthur. I'm Arthur Kemp. I own a couple of companies, Exact Capital Allowances being one of them. And as you say, we specialise in capital allowances and have done really since 2008, where we first started off dealing with HMO properties and have moved on to more sort of serviced accommodation, commercial properties, and due to some updated legislation recently, back into HMOs in a big way. So
we'll definitely touch on that later, especially with the update there. So the question, well, it's not really a question really. Most people aren't really aware of what capital allowances are, except for they're kind of aware of the usual stuff, such as your plant and machinery and your laptops and getting those through. But what's different about the capital allowances that you get involved with?
So lots of people may have heard the phrase capital allowances, but don't necessarily know what it means, or they might think that their accountant wholly deals with it. But in effect, what happens is when you buy a property, you're able to claim a tax deduction for some of those items within that property. And there's a few phrases that are banded around, and one of them is plant and machinery, as you mentioned. Now, plant and machinery, to simplify it for lots of people, is generally all of the second fix items in a property. So when you build a property, then you obviously got the structure of the property, the foundations and the walls. Then you fit the property out and make it work. And it's all those items which are second fix items. And that generally is what capital allowances are. That's the plant and machinery, and it's that value of things that you can claim for. Now, you can claim in a number of different circumstances. So whenever you spend money on a property, you buy some of this plant and machinery. So whether you buy a property second hand, which is generally the case, when you're buying that second hand property, there is a proportion of that which is the plant and machinery. And part of our process is to attend the site, do the valuations, and break down the purchase price of a property into its component parts, some of which will be this plant and machinery that you can get a tax deduction on. The other times when you can claim is when you're developing a property. So again, once you've bought the property, you might decide to extend it or convert it and make it bigger, or restructure the internals of the property. Again, you're spending money on the property and you're buying and spending money on the plant and machinery, more second fix items, more bathrooms, more kitchens, more heating, more lighting. All of those things that you spend money on is what you can get a deduction on. So capital allowances is a fairly broad subject, if you like, although it is quite niche in its own right. But capital allowances generally covers the plant and machinery within a property, although it does cover certain other things in terms of structure and buildings allowance for commercial properties, and land remediation relief, which is a very valuable tax relief, and is generally around the idea if you're going to remediate any contamination on land or a building. Typically, we find that's asbestos in properties, or Japanese knotweed, or oil contamination in the ground. So if there's any contaminants, then capital allowances covers the remediation of that, the tax relief on that.
I suppose that's a great place to kind of move into. So land remediation relief, what is that, and who can benefit from it?
So land remediation relief is a tax relief which you can claim if you clean up contaminated land or buildings. As long as you didn't cause the contamination yourself, then you're able to make a claim. But generally, people buy, let's say, a 1970s office building to convert, and that office building will have asbestos in it. So as long as you've bought the property within a limited company, then that limited company is able to claim the cost of the land remediation relief. So cleaning up that contamination, that asbestos, all of the costs associated with that, not just the building costs and the cleanup costs, you're allowed to claim a whole host of other things as well. But 150% of the value of that. So not just the cost of that, but 50% more. And one of the good things about land remediation relief is if you're doing it as part of a project, you can actually surrender that land remediation relief in exchange for a tax credit. So that can help with your cash flow if you're at the start of a project as well. So it's a very valuable tax relief that people don't really know about, but it can make a big difference, especially if you're doing a sizable project. Yeah,
definitely. So what types of property investors and business owners can actually benefit from capital allowances?
So I can break that question down into two parts, if you don't mind. One, what type of properties benefit, and who can actually benefit from the tax relief? Well, if you have a qualifying property, which I'll come on to in a minute, whoever owns that qualifying property is entitled to make the claim. So generally, in the past, before there was interest rate restrictions, properties were generally owned by a couple or a couple of business partners. And each of those individuals were entitled to their share of the profits and losses and capital allowances as well.
Yeah.
So that would be traditionally how it works. More so now, businesses or limited companies are set up for property investment purposes. And that limited company may be the one that owns these properties. And as long as they're qualifying properties, that limited company can claim the capital allowances. And the way that it works is, once that we've done the valuations, there's simply a couple of lines that go in the tax return, as you well know, which then reduce the taxable profits in that limited company or on those individuals' tax returns. And there has the benefit of either utilising sideways loss relief. So if you have a property that's owned in your name and you have other income, PAYE income, for example, you can utilise the capital allowances in your property investment against the tax that you pay through your employment. And that's a really powerful tool, especially if you're building up your property portfolio and you're looking to find other ways to gain extra cash flow. You don't have to pay tax over to the revenue. And it's really quite valuable, especially at the beginning of your property business. But the other thing that we'll come on to is the types of properties. Now, the legislation says that you cannot claim any capital allowances on a dwelling house, and that's perfectly right. So generally, if it's somebody's principal residence, then you're not able to claim on it. So regular buy-to-let properties where you're letting it out to an individual or family, they won't qualify for capital allowances. The revenue look at that whole building and see that it is a dwelling house in its entirety. If that property is used for serviced accommodation, however, that's short-term rentals, that will qualify. The same as Airbnb units, hotels, any commercial property that you can have, from offices to retail spaces to petrol stations, hotels, offices, dental surgeries, a whole host of those properties qualify. There's also another group of properties, HMOs, and the revenue have been taken to court recently, and a judge has determined that for these types of properties, yes, you can claim capital allowances on them, but only in certain areas. These areas known as common areas, and these are areas which are offer no facilities to the people who live in the property, but still make up a relatively small part of the property. As well as that, you're able to claim installations on the whole building as well. So that's where the sort of value is. So for HMO properties, because of this recent adjudication, it's very clear that you're able to claim for round about 13 to 15% of the investment in a HMO property. And that's something which is fairly new, and lots of people should be aware of that because it's very, very valuable.
It's been quite previously, it's kind of HMOs have been allowable for capital allowances, eligible, and then they've kind of gone out of fashion, now they're back in again. So kind of how's that worked through time, and kind of what's resulted in them coming back into the scope of capital allowances?
So we were the first company in the UK to look at HMO capital allowances back in 2008, and the revenue issued their briefing statement 6608, which basically said for multi-occupancy properties, they deemed that the tenant's bedroom were dwelling areas, and you couldn't claim for those, but the rest of the property were non-dwelling areas. So therefore you could claim capital allowances on those, and so we did a lot. And they tried to update their guidance in their briefing statement 4510, which made it a bit more of a grey area. And then as time went on, the revenue received more and more claims for capital allowances for HMOs. And without that clear sort of legislative guidance, they were very apprehensive about approving those particular types of claims. However, since this adjudication has been made recently, it's been very clear that these are the areas that you can claim on these properties. So it makes it even more pertinent for people investing in HMOs to make sure they claim their capital allowances. It's a legitimate tax relief now that you can claim. And as I said, capital allowances in general have been around for nearly 150 years now. So the fact that it now applies definitely to HMOs is a great thing.
So really, there's never been a better time to look at getting a capital allowances
surveyor
involved in your HMO property business.
Exactly.
Would that be a fair thing to say?
Yeah, I think so. I think a lot of the times, especially with interest rate relief being restricted, if you like, people are looking for other legitimate ways to reduce paying tax. And one of the few things that is out there is capital allowances. So if you have properties which qualify, as I say, HMOs do, serviced accommodation units, but not sort of regular buy-to-let properties, then why not take advantage of the tax relief? It's there to be used.
Yeah, absolutely. So in regards to, you mentioned kind of owning the property. So where would you stand if you were a leaseholder?
So if you were leasing out a commercial property, which generally happens, then what typically happens is the freeholder that owns the property, they will be able to claim some capital allowances on generally the services and utilities they provide. But you as the leaseholder, if you fit out that property to your business, you may incur some additional plant and machinery and you can claim for that. Typical examples we see is when a freeholder, a landlord, buys a mixed unit property. So mixed use property, sorry. So on the ground floor, there'll be a retail space and they'll have flats above maybe 2 or 3 floors. And they may decide to rent out those flats as buy-to-lets or serviced accommodation or holiday lets as well, entirely up to them. But the ground floor, they'll generally just be able to claim capital allowances on the services and utilities they provide. But then as the tenant, from the leaseholder's point of view, if you then go into that property and fit it out with air conditioning, and you might have special flooring, or you might have some counters that you install, special lighting for your trade, then all of those things you'll be able to claim capital allowances on as well as the leaseholder. But whenever you spend money on property investing, for want of a sort of looser phrase, then generally there's an opportunity to benefit from the tax relief.
Okay, yes, definitely. So kind of rent to SA, and that there's been a rise in popularity of that at the moment. So would you agree that if you're even got a kind of 5-year lease agreement in place, then unfortunately there's no way you can claim capital allowances on the building you're using?
Yeah, so rent to SA, for example, is fairly clear in that you have to be the owner of the property to benefit from the capital allowances. So lots of people who are looking at rent to rent, rent to SA, are there. Obviously, it's great for no capital in, if you like, or minimal capital investment, and you may make great monthly returns on the increased rental. However, you don't own that property. You are operating that property on behalf of the landlord. So you as the operator cannot benefit from the capital allowances on the property. However, there is a potential that the landlord may benefit from capital allowances if they have a vested interest in the profitability of the serviced accommodation business. But that gets more complicated depending on the agreement that the leaseholder has with the landlord as well.
Yeah, and in circumstances like that, you'd almost have to make it a joint venture agreement, wouldn't you, when they've got the risks and reward, or something along those lines. So that they're almost acting, and then the rent to SA person would become an agent, essentially.
Yeah, exactly.
Yeah, but in that case, it's a great point to kind of market yourselves to these landlords, to the fact that they might be available to claim the capital allowances. Okay, so in regards to the typical value of a claim, what's the rough percentage, or how do you determine that? What would a typical claim look like? So it's very complicated, the valuation process, because it very much depends on the purchase price and overall investment in the property. It's been quite complex in the past, whereby, especially if you're buying second-hand properties, what is the true value of the plant and machinery? If you're buying a second-hand kitchen, which you can claim capital allowances on, what is the value of that kitchen? Well, most generally, people tend to rip out the kitchen, so you could argue that the value is zero because it has no resale value. However, if you were to replace it, then that does have quite a significant value. So a while ago, HMRC asked the Valuations Office agency to come up with a solution for this. And so the solution is that every property you buy second-hand, you're able to claim capital allowances based on the replacement cost of that plant and machinery. Okay. So even though you're buying a kitchen which has a nominal value of zero, you can claim the capital allowances based on its replacement price. However,
You then have to then factor in the land valuation of the property and also the reconstruction cost of the property.
Okay.
You also have to then factor in where the property is located in the country based on various indices as well. And you have to, the main factor is the purchase price of the property. So taking that all into account, generally, as a general sort of rule of thumb, if you're buying a second-hand property, around 20% of the purchase price will be the capital allowances value. And that's sort of a general ballpark figure.
Yeah.
Typically we see a bit more, but if you just use that as a sort of rule of thumb, if you're looking at a particular deal, you can factor in the fact that it will be 20% of that purchase price will be the capital allowances value. But this is just the capital allowances value that we're talking about. What that cash value is to the actual investor depends on what rate of tax that they pay, of course. So if that property is held in a limited company, and limited companies pay corporation tax at 19%, if you've got £100,000 worth of capital allowances, well, over time, that will save you £19,000 off your tax bill. However, if you have the property in your personal name and you're a higher rate taxpayer, well, that could save you £40,000 or £45,000 in tax, depending on your circumstances. So the actual value of capital allowances is a factor of the purchase price of the property, the type of property it is as well, because certain properties have a lot more plant and machinery in them. I'm sure you can appreciate if you buy a warehouse is generally fresh air, so there's not an awful lot in there. There might be some offices or lighting and a toilet block, so they will generally yield lower values of plant and machinery. But if you're going for sort of medical buildings or hotels, B&Bs are quite good for capital allowances as well. All en-suite facilities, fire installations as well, emergency lighting, air conditioning. There can be really high yields in terms of capital allowances. So the type of building can make a big difference, and again, who owns the property. But part of our sort of process is to take basic information and then provide like a desktop analysis, like an initial assessment to say, for these properties that you've got, this is the typical amount of allowances that we'd expect to find. So therefore, based on your tax rate, we can calculate the true value of that tax relief. And then, of course, it's a simple exercise to look at that and see if it's worthwhile.
Yeah, so running for a quick case study. So suppose, say for instance, that you're a serviced accommodation operator, you've just bought a nice 3-bed terraced house for £200,000. So there's quite a lot of planning that can be done here, really. So if they approach an accountant and yourselves to start with, and they're just starting out, so quite a common structure for this might be to incorporate an LLP or some kind of tax transparent entity where they're a high rate taxpayer. So that effectively they can go for a couple of years without paying any tax. So on a £200,000 property, how much would they expect to get in capital allowances?
So again, as a general rule of thumb, if you assume 20%, it will be a little bit more for serviced accommodation. But yeah, I would expect to get £45,000, £46,000 worth of plant and machinery from that property. So that's the sort of values that we're looking at. And of course, you have the opportunity there, as it's in an LLP, to either each member to utilise the losses. In the first year, you generally don't expect to make huge amounts of profits. You might have some further development expenditures, some of which will be written off as repairs and renewals. So the large part of your loss in your property business will be because of the capital allowances. And so each member of that LLP can utilise those losses against other income. You also have the choice, if that's not preferred, you can roll forward that loss into future years. And depending on individual circumstances, some people are happy to take the capital allowances today, to utilise them against their other income to get a cheque back from the revenue, which is always a popular thing to do. Or in some circumstances, people are happy to take the big £45,000 loss, roll it forward, knowing that they might be making, let's say, £15,000 a year profit expected, so they won't have any tax to pay on that property business for the next 3 years. And that's really good for cash flow.
No tax for the next 3 years. You can't really do much better than that, can you?
Everyone's happy.
Well, no tax for 4 years. So in terms of doing the sideways loss relief, what makes... This is kind of a question for myself as well, actually. So, in terms of sideways loss relief, what makes a service accommodation business different from a furnished holiday let in the availability of the sideways loss relief?
Holiday lets we haven't talked about much, but again, are very, very valuable for capital allowances. The problem with furnished holiday lets is that they're ring-fenced in terms of sideways loss relief. So capital allowances, yes, completely available for holiday lets and anywhere in Europe as well, which is great. And they can yield quite a lot of capital allowances, especially if you're looking at swimming pools and jacuzzis and air conditioning. You get quite a lot. However, furnished holiday lets have a specific set of rules, and you cannot use the allowances against other income, and that's ring fenced. So one of the main differences between a holiday let and serviced accommodation is that with a holiday let, yes, and it might even be a very similar type of property, is effectively the availability of sideways loss relief. In a furnished holiday let, no, you can only use it against your furnished holiday let business. But if you operate a serviced accommodation where you're providing additional services, short term, professional people staying, and holiday stayers as well, holiday stayers isn't the right word, holiday makers as well, then you can use those allowances against any income stream that you have. And there's also different places to report that on your tax return as well. There's a specific section for holiday lets, and therefore the availability of capital allowances is greater in terms of you can utilise the sideways loss relief for serviced accommodation than it is for furnished holiday lets.
Yeah, so it's very valuable relief.
Very.
I've heard this pooling election before. Would you be able to describe a little bit about that is and how we should probably take extra caution with our due diligence when buying second-hand properties?
Yeah, so whether you're buying a residential property or if it's one's for serviced accommodation or a commercial property, it's really important to do the compliance work. Now, the rules now say that you have to agree the capital allowances between the seller and the buyer in order for you as the investor, the buyer, to claim capital allowances, provided that the previous owner could have claimed capital allowances. So in a typical example, if you're buying a residential property and converting it into a holiday let or serviced accommodation, you don't necessarily need to get too involved in that, because as it was a private dwelling before, the previous owner couldn't claim any capital allowances, so therefore that part of the compliance is satisfied. However, where it gets more complicated is where you buy a commercial property or a going concern, which might be a holiday let or a serviced accommodation or a HMO, where the previous owner could have claimed the allowances. And it's a bit of a dichotomy there, because you don't necessarily know if they've claimed the allowances, but of course you don't want to speak to them and say, have you claimed this tax relief? Because they might decide to then speak to their accountant and then look at going down that avenue, and then potentially you as the investor has lost. So there's a few ways around this. You need to have that agreement in place. So you can either put specific clauses in the sales contract that allow or that force effectively the seller to pass on the allowances to you as the buyer, or you can have some sort of standalone agreement within the contract that says they will pass it over to you in that instance. Generally what we find is sellers normally haven't got a clue about capital allowances. If they're selling a property, most of the time they're not interested in tax relief or capital allowances. They just want to get the sales price for the property and they want to move on. And they're quite happy to sign over an election, which doesn't cost them anything. Their only loss is the fact that they haven't claimed this tax relief in the past. And it generally is the case that they're perhaps not making huge amounts of profits on their particular property, so they're not paying huge amounts of tax. So capital allowances aren't generally on their radar or necessarily something they're interested in. But I think it's fair to say that most people who are selling properties are not aware of capital allowances, and they're generally quite happy to sign over the elections, which of course is to the advantage of the savvy investor.
Yeah, absolutely. Those watching this, they've definitely got their thumbs up on this. Heads up. So if you're a seller that's already claimed capital allowances, when you sell the property, do you have to repay any of those, or how does that work?
So if you already own a property where you've claimed the allowances, what we generally advise is you should put a restrictive election in the contract, which sounds quite complicated, but it's very straightforward. It's a paragraph which limits the new owner from claiming all the capital allowances that you've claimed. It's called a Section 198 election, and you effectively fix the sale price of the plant and machinery that you've claimed on to £1. It doesn't affect the overall sales price. whatever you agree with the buyer that you're selling the property for, that's still the same. What you're doing is you are apportioning the sales price to £1 of it being relevant to the plant and machinery that you've claimed on. And that means that the new owner can't then claim any capital allowances that you've claimed. Having said that, the onus of responsibility these days is on the buyer to actually get the seller to agree the capital allowances value should they want them. And then that opens up an interesting point, because if you are a seller and perhaps you're no longer paying huge amounts of tax, but there might be some capital allowances available, you then have the potential opportunity to agree with the buyer to pass on those capital allowances that you might not benefit for a price.
Okay.
So if there's, let's say, a balance of £50,000 worth of capital allowances, and you are retiring or you're no longer in a tax-paying position, you may decide at a separate agreement with the buyer for them to have those £50,000 worth of capital allowances for some sort of incentive for you.
Yeah, and that's perfectly legal.
Of course.
Okay, great. So in terms of people just starting out, what are the kind of key tips that they should be looking at? What are the kind of key factors they should be aware of in regards to capital allowances?
So first of all, you should be aware that capital allowances will be available on most properties that you're buying. When you are looking to buy a property, if it's residential, then that's perfectly fine. You don't need to panic too much about getting any agreements with capital allowances. If you're buying a going concern in terms of a holiday let or serviced accommodation, it's very important to A, know who you're buying the property from, and B, know or have a look what's in the contract to see if there's any restrictions. So knowing who you're buying the property from is really important, because if you're buying the property from, let's say, somebody who doesn't pay tax, then automatically you get the capital allowances.
Okay.
So if you're buying, let's say, from the local authority, the local council, for example, if they're selling properties, they don't pay tax, so therefore you get the capital allowances. If you're buying from a charity, exactly the same, or a pension fund, then that's a great position to be in, because by default you get all of the capital allowances because they don't pay tax. However, if you're buying from an individual or a limited company or an LLP or people that may have claimed tax, then it doesn't necessarily mean that you can't claim, it just means that there's more steps and more compliance work to go through. But I know certain people that we work with are actively pursuing buying properties from people who they know don't pay any tax at all, because they're outside of the scope to tax. Therefore, they by default get the tax relief, which is very powerful. So know who you're buying the property from, and if any questions at all, just pick up the phone, and we're more than happy just to talk you through that particular transaction.
Yeah, definitely. That leads on to wrapping things up very nicely. So people who want to find out more about you and get in touch to see how you can help their business, what's the best way to do that?
Well, all over social media these days, but best one is to go to exactca.co.uk or give us a call in the office 0845 467 2765, or you can email me hello@exactca.co.uk and we'll respond very efficiently.
Okay, that's all for today, guys. Thank you very much for watching. I hope you've enjoyed it. Please do like, share, comment, you know the drill. Look forward to seeing you next time. Cheers.
Thank you.